Embark with us on a new adventure towards financial prosperity. Today we set sail into the world of a powerful wealth-building tool, index funds. This will take us deep into its core, unveiling its essence and demonstrating its potential in shaping your fortune. Fear not the complexity, as we'll simplify it all into easy, digestible nuggets of knowledge. An exciting journey of financial growth lies ahead, so fasten your seatbelts and prepare to explore the magic of this wealth multiplier. Let's dive right in and unravel the mystery of what are often known as index funds. Picture a basket. However, this isn't just any regular picnic basket. This special basket is filled with an assortment of different stocks, bonds, and other types of investments. This, dear listeners, is what lies at the core of what we call an index fund, a kind of mutual fund often referred to as an ETF. In simple terms, this type of fund mirrors the components of a financial market index. But what exactly is a financial market index? It's kind of like a hypothetical collection of investments that signify a section of the financial market. The index value is derived from the prices of the chosen stocks. For instance, you might have heard of S&P 500 or the Dow Jones Industrial Average. Now our special basket, the index fund, aims to duplicate the performance of a specific index. Instead of cherry-picking individual stocks or bonds, the fund manager mirrors the index, buying identical securities in the same proportions. So if you invest in an ETF tracking the S&P 500, you're basically acquiring a microscopic portion of the top 500 companies in the US. This method, often dubbed as passive investing, based on the optimism that eventually, the market value will rise, despite temporary dips. What makes these index funds really appealing is their expansive market exposure. Rather than putting all your eggs in one or just a few baskets, you're scattering your investment across a broad spectrum of companies or bonds. This dispersion of investments can considerably diffuse risk. Moreover, these funds are popular for their economical operating costs. They merely mimic an index, eliminating the need for thorough research or hands-on management, translating into considerable savings for you, the investor. Also, they promise low portfolio turnover, meaning the securities within the fund aren't frequently traded, leading to lesser transaction costs and lesser taxable events. In a nutshell, these funds offer you expansive market exposure, cost-effectiveness, and low portfolio turnover. They're the key to building wealth in a smart and efficient manner, by spreading out risks and keeping expenses low. Now we've defined index funds, let's explore their functionality. Think of a mirror reflecting an image. This is analogous to our topic. The primary goal here is to duplicate the performance of a financial market index. Financial market index, in simple terms, is a theoretical basket of investment holdings, representing a market segment. The S&P 500, a renowned example, is replicated by our subject, that is, the fund invests in the same stocks in the same proportions. Hence, when the S&P 500 climbs, the fund does too, and vice versa. Unlike actively managed funds, where a manager is constantly trading stocks, our subject merely follows the index, reducing expenses and offering a significant benefit. What's fascinating is, just like a buffet offers a variety of dishes, our fund provides an assorted range of company stocks to invest in. As opposed to risking all your capital in a single stock, you're diversifying your wealth across several businesses. This balanced investment approach aids in mitigating risks. Sum up, our subject is a type of mutual fund built to match the parts of a financial market index. It offers a broad market cover, less operational expenses, and minor portfolio turnover. It remains loyal to specific rules or guidelines irrelevant of market conditions. They're akin to a mirror reflecting a financial market index and provide a simple, cost-effective method to grow and protect your wealth. Now enters the intriguing part, the role of these unique funds in enhancing your fortune. The charm of these funds, often referred to as index funds, is rooted in their marathon-like strategy. They're not a sprint to overnight riches, but more akin to a tree slowly and steadily growing stronger day by day. It's about setting the foundation and waiting patiently for it to yield rewards. The larger the time frame, the greater the potential for your seed money to bloom. Central to this growth is a concept called compounding. Picturing a snowball tumbling down a hill might help. As it rolls, it keeps gathering more snow, becoming bigger and bigger. In the investment world, compounding is the phenomenon wherein the returns you make are reinvested, and they too start generating profits. Think of it as a cycle of earning profits on previous profits, leading to an exponential increase in your fortune over time. For instance, imagine you invest $1,000 in one of these funds and it yields a return of 10% annually. By the end of the first year, your pot would increase to $1,100. If you let that money stay invested, in the second year, your returns won't be just on your initial $1,000, but on the new total of $1,100. This is the beauty of compounding. Given a few decades, this could result in a significant stash of wealth. One of the reasons why these funds are potent tools for wealth creation is their cost-effectiveness. Unlike funds that are actively managed and come with high fees, these are passively managed, their goal being to replicate the performance of a particular index. As a result, their costs are quite low, allowing more of your money to stay invested and keep growing. Moreover, these funds offer automatic diversification. When you invest in one, you're essentially acquiring a tiny portion of each company in the index. This spreads your risk across a wide range of companies and sectors, cushioning the blow if any one company falters. It's like not putting all your eggs in one basket. However, remember that all investments come with risks. Past performance doesn't guarantee future returns, so it's vital to do your homework and consider your own financial circumstances and risk appetite before investing. With patience and time, these funds can work wonders for your financial growth. They embody a simple, cost-effective, and diverse way to tap into the stock market. They could potentially help you amass a considerable fortune over the years thanks to the power of compounding. So if you're on a quest to grow your wealth, remember this unique investment option. It might just be the seed you need to sow for a prosperous future. We've gathered some great insights today about these unique investment tools. To recap, let's start off with their simplicity. These tools, also referred to as trackers, mimic the performance of particular market indexes. Instead of the intricate task of selecting individual stocks, trackers let you invest in expansive market sectors. It's like owning a small slice of the whole market. This simplicity makes them a fantastic choice for all, from investment newcomers to the experienced. Next up, let's touch upon the affordability. Known for their low expense ratios, these trackers are passively managed, meaning they simply follow an index rather than needing constant trades by a fund manager. This saved fund can be reinvested, progressively growing your wealth. Now let's consider the aspect of diversification. When you invest in a tracker, you're essentially placing your bet on a wide range of companies. This reduces your risk across many stocks and helps dampen potential losses. If one firm doesn't do well, others may balance it out. As a component of any solid investment strategy, diversification is integral. Trackers provide plenty. Lastly, let's remember that this is a long-term play. It's about steady growth, not hitting a windfall. We're cultivating wealth, not looking for an instant fortune. The power of compound interest over time can lead to substantial growth. This is like the tortoise and the hare fable. Slow and consistent always wins the race. Also, dividends often paid out by these investment tools can be reinvested, purchasing more shares and boosting your wealth growth. In conclusion, these trackers offer a simple, affordable, and diversified investment strategy, purpose-built for long-term growth. This isn't about getting rich overnight. It's about steadily building wealth, one step at a time. Remember, wealth cultivation is a journey, not a dash. And these investment tools can certainly be your trusty companion on this rewarding venture.